Hello, and welcome to the headline segment of Making Sense of Markets Quarter 1, 2017. My name is Matthew Carvalho, Director of Investment Research here at Loring Ward, and I'll be your host for this segment. The headline segment is meant to put some perspective around topics that you may be seeing in the financial press and provide context for how those issues may impact a long-term investor. Headlines in the first quarter of the year range from optimism to nervousness. We started off the quarter with CNBC mentioning that the Dow closed above 20,000 for the first time as Trump orders sent stocks flying. Stocks continued to rally into February, with Business Insider noting that U.S. stocks have hit all-time highs. Yet the very next day, Yahoo Finance ran an article titled 10 Reasons to be Nervous About the All-Time High Stock Market. Those worries were quickly brushed aside, however, as the Dow pushed past 21,000 on March 1st. However, stock market concerns were raised again in the Financial Times article towards the end of the quarter, saying worries about stock valuations reached their highest level since 2001. And that was actually a topic we saw quite a lot of press on towards the end of the quarter, the idea that the valuation of the stock market had risen too far and too fast. So let's examine that a little bit further. Much research has been done on stock valuations, and historically buying into the market at lower valuations has seen higher returns than when buying in at higher valuations. However, the data is extremely noisy. On this chart, the green area represents the 10-year trailing price to earnings ratio of the S&P 500, commonly referred to as the CAPE ratio. You can think of this as a gauge to see if the overall price of the stock market is expensive or cheap relative to historical averages. And as you can see, we're currently at a fairly elevated level, around $29 of price for every dollar of earnings, though far below previous peaks. Now, it can be enticing to think that it's possible to try and time the market based on valuation ratios like these, but even the creator of this ratio, Professor Robert Shiller, cautions against using the ratio to make trades. And keep in mind that you have to guess right not only once, but twice, knowing when to get back into the market. Take, for example, the last time the 10-year trailing PE ratio of the S&P 500 broke through the current level, which was back in February of 1997. Now, had you sold out fearing high valuations at that time, you would have missed another 3 years of up markets, culminating in an additional 86% gain before seeing any meaningful decline. And at that point in February of 1997, the S&P 500 was trading at 798. If you sold out waiting to buy back in once markets were lower, you would still be waiting over 20 years later, and meanwhile the S&P 500 is above 2,300 now. Also, step back for a moment and congratulate yourself, because you've likely participated in the gains that the market has provided in the recent years. This chart takes a world map and resizes countries based on the relative size of their stock markets. And as you can see, the US is far and away the largest single country, yet it only represents about half of the overall world market. By including investments in other countries into a portfolio and rebalancing those allocations over time, you may reduce your concentration of exposure to any one market, such as the US. Not only is diversifying your country exposure a good practice, but you may also take comfort knowing that many countries around the world are trading at far lower valuations when looking at the same CAPE ratio. For example, the United Kingdom at 15.3, China at 14.4, or Australia at 17.5, all being far below the current ratio in the US. Now, having a high or low ratio doesn't necessarily mean high or low returns going forward, but to address the worries of any individual market, such as the US having gained tremendous amounts in recent years, having a well-diversified global portfolio means you're not too concentrated in any one market. There are periods when U.S. markets will outperform and periods when international markets will outperform. And over time, this has been fairly random. In the mid-'80s and the mid-2000s, international markets greatly outperformed U.S. for long periods of time. However, in the late 90s and over the last few years, U.S. markets have outpaced their international counterparts. Because the two markets don't move in perfect lockstep, there may be benefits to the performance of a long-term portfolio by having a combination of the two. Let's end with an intuitive way to think about global diversification. Take any individual sector in the economy. In this case, we'll look at automobiles. Now think about all the options out there in the marketplace. But what if your options were only limited to those brands headquartered in the US? well, your universe of choices shrinks dramatically. Being a researcher by trade, I certainly put in more hours than I'd like to admit researching our most recent vehicle purchase. After factoring in a growing family at home, I'm now the proud owner of a big, beautiful minivan. And that minivan wasn't built by one of the domestic manufacturers on the screen. But wouldn't I want to own the stock in a company whose products I find valuable? So instead of limiting yourself to any one marketplace or stressing out about a particular valuation ratio or metric of the day, keep in mind that a globally diversified investor likely holds thousands of companies all around the globe, trading in different markets and at different valuations. For additional commentary, please view the Making Sense of Markets portion of the Loring Ward channel on YouTube.